We're Compound Everything. We talk money, markets, and investing. And this week we are profiling a great investor, Nick Sleep. And profiling investors is one of our favorite videos to make because we can learn so much from their investing style and life.
Yeah, I actually liked reading a lot about Nick Sleep. He seems just like a genuine soul as I was reading his letters. Now, you can find some information about Nick Sleep online. If you Google Nick Sleep and you look up unit holder or shareholder letters, you'll find about a 220-page document that's just all of his and Zach's, his business partner, their letters, and you can read through them, and they're very informative.
So the nice thing is about these shareholder letters, you kind of get a feel for both partners. And a lot of people talk about Nick Sleep, but they don't necessarily bring in the partner Zach. But they kind of go together. You can't talk about one without the other.
They're kind of like Warren Buffett and Charlie Munger. Is my sense of after reading about them.
Yeah, I got that impression. Essentially, over the lifespan of their fund, I think that was from 2001 to 2013.
214, yeah.
To 214. Yeah. I think they returned something like 921%.
Yeah, which is 20% annualized.
Yeah, and the world index returned 600 and something percent. So quite a large difference in their favor.
So they handily beat it.
Yeah.
So 20% returns over that time frame is huge. So these guys are serious investors. Annualized returns. Yeah. So these guys are serious investors. They knew what they were doing.
Yeah. Now, one of the things that caught my attention from the very beginning, because we've talked about this often, is that Nick Sleep did not have any sort of education, from what I could find, in business or in like an MBA.
Finance.
In finance.
He didn't have an MBA as far as I'm aware. He didn't work in, well, I guess he did work in finance, but his education was not in business and finance.
Yeah, so he wanted to be a structural architect, and he said he had these like romantic ideas of what that would mean for him.
Right.
And then he got a job and he realized it really wasn't what he thought. And he actually studied in university. I think he started with geology and then transferred over to geography, or maybe it was the other way around.
Yeah, something like that.
But like that was his education. And then Zach, which we'll call him, which Sleep calls him as well. Yeah. He studied mathematics and he went to Cambridge, and they were immigrants. He said they got, I can't remember the word, purged, maybe was the word, from Iraq. So they came in with pretty much nothing, and his dad built a business, and education was very important to them, and actually money was very important to them. And I laughed when I read, there's a line that I read by Zach that says, my money was very important to my parents, not to spend, but to accumulate. And I thought, oh, that's kind of like a...
Yeah, I understand that. I feel that.
Yeah.
And so together, these two gentlemen ran the Nomad Partnership. And structurally, I'm trying to figure out exactly how it works, because they also worked for a organization called Marathon. Yeah. And so at some point, I guess they started the Nomad Partnership while working for Marathon, is the sense I get. And at some point, I think in around 2006, 2007 maybe, I think they broke off and just ran the Nomad Partnership. And that was I guess they just ran with that.
Yeah. And there are certain things that kind of shaped their investing philosophy from the very beginning. And so, I mean, like you said, Nick Sleep is just a very, he seems gentle, right? He seems genuine and kind, and he's private.
Yes.
So he never needed that spotlight of Wall Street. He never needed that big name. So that kept him really grounded in his investing philosophies. And then for Zach, just coming in and having parents have to build up a business, and then his dad actually went bankrupt because it was a scam. It sounds kind of like a boiler room scam in a sense, and he wasn't at the top, so he put a lot of money in. I think that was really pivotal to his philosophies in the market and how one should handle other people's money.
So you came by a line from Zach about his father and how he kind of earned this money and then lost this money. Yeah. So what was that?
Yeah, so he actually built a very good business and did very well in it. And his exact quote was, "My father made a lot of money in things he understood and lost it in things he didn't."
And I totally see that as reflected in the market.
Yeah, and you see that reflected in their research habits and in the way they managed their fund.
Yeah.
And they were just it seems like two really great money managers, but just really great guys in general.
And so going along that vein, I mean, there's some wisdom there for us as investors, right? Invest in what you know.
Yes.
Right? So at this point, let's dive into a little bit about their investing habits, let's say. Okay. So one quote we came across was that they had annual reports like literally stacked to the ceiling. So they did an incalculable amount of research on the companies that they invested in. And it sounds like they initially began with an investing style that kind of changed later on. So early on in their partnership, they really focused on three things. So their initial investing philosophy focused on companies with moats, companies focused on significant assets or that held significant assets, and they actually liked cash as being a large component of their assets. And then the last one was deep value investing. And later on, their investment philosophy kind of changed or shifted, and we'll maybe talk about that a little later. So in their first investment letter, their first shareholder letter, they describe their investment strategy. They say that they look for businesses that are trading at approximately half their intrinsic value that they calculate. They look for businesses that are run by owner-oriented management, and they look for capital allocation strategies that are going to promote long-term value. That's it.
Yeah, I think he says rational capital employed decisions is how he looks at it. So in that first shareholders letter, he also mentions the breakup of the portfolio in that letter. And I think 41% of it was moat companies or companies with strong advantages.
That's right.
And so even at the beginning, I know you say they shifted, that was still always like...
It was ingrained there, that's true.
It was still always the biggest portion of their portfolio.
Yeah. I noticed in one of their early shareholder letters as well, as they broke down some of the companies. Well, they didn't break down the companies per se, but they broke down the portfolio and said, well, these are the ones that we have. We have the moat companies, we have these asset-backed plays, and then we have these deep value plays. And the ones that have done well are the first two categories, and the ones where we've actually lost money are in the deep value categories. And so maybe that kind of led them to change their philosophy a little bit. They kind of abandoned the deep value strategy to a point and then focused more on the first two.
A lot of value guys have abandoned deep value.
Yeah.
So it's just, and people say, the scariest phrase in the market is this time it's different, but there are things that are different as time goes on, and that might be one that, like cigar butts and deep value, just it's not the same as it once was.
Right.
Things change and the market's fluid, and I mean, even as America particularly becomes a older country, more established, it's obviously going to be very different than when they were building up their economy and like working towards that position of being the strongest economy in the world.
I wonder if it could be that in part. The other thing it could be is that as they acquired more funds, those deep value propositions just dried up because as you're dealing with more,
they couldn't allocate enough money.
Right, as you're dealing,
had too much money to allocate.
Correct. So these deep value plays may be smaller companies and they just don't move the needle anymore. I'm not entirely sure why. And so one interesting observation, though, is that most value investors, or a lot of value investors, cut their teeth in deep value.
They start there.
So that's where they cut their teeth. Yeah. And then later on, they go towards more the GARP or growth at a reasonable price, or just
wonderful
buying wonderful companies at fair value, Charlie Mungerisms and that kind of thing.
And they just kind of find what works for them and what they're good at. But maybe deep value helps them because you really have to know when you're doing deep value, you have to really understand accounting. You have to really dig into the financials. So it probably gives them a really strong foundation to venture out of deep value and feel comfortable there. And maybe that's why. So one of the things that got my attention was that they held, I can't remember exactly, but it was in the 20-something stocks.
Yes.
And I don't know why, but I just assumed that they would have held less. And I think it's because their statistics saying that, like, at one point, all of Sleep's capital was in one, because they ventured off and they handle their own money now.
Yes.
And I think at one point, all of Nick Sleep's capital was like 70% in Amazon, or something like that. So he held like 3 stocks.
Yes.
Right. And so when they were running their fund, I just assumed that would translate, but they actually had like 20-something companies.
Yeah, and I'm not
point in one shareholder's letter, I remember him saying the amount. I was like, oh, okay, that's more than I would have thought.
Yeah, I'm not sure why, and they never explicitly list all the companies throughout the shareholder letters. So they
do take certain companies and then do like a write-up for their partners.
Yeah, one or two per letter, generally speaking. And so they'll break down what they see in these companies and how they've performed, etc. So it's worth a read even for that.
Right, because you're like, okay, he was, that's fairly diversified, 20 companies.
Yeah.
And then when they handled their own money, it sounds like they went much more concentrated.
Yeah, and so one of the things that they talked about is how they would invest worldwide.
Yes.
They weren't limited to, North America or otherwise. They went where the value was.
And even if the macroeconomics were horrible, that did not bother them.
And some of the worst macroeconomics, were in Zimbabwe, and they went there.
Right, during not just in Zimbabwe as a blank statement, they went into Zimbabwe when they were going through major hyperinflation.
Yeah, and at one point in one of his letters, he describes how basically it wasn't that the markets closed in Zimbabwe, but there was like no quotations on the stocks at all in Zimbabwe, and they held something to the tune of just under 1% of the portfolio in these Zimbabwe stocks and whatnot.
Imagine you're giving someone your money.
Yeah.
And they tell you like, oh, and by the way, we're putting it into Zimbabwe.
And you're going, what?
Yeah,
why would you do that?
Yeah.
Nothing about that seems rational.
Yeah.
Except that at one point in the letter, he says, essentially, accept a zero quotation for these stocks because we can't get a quote. So zero it is.
Yeah.
We know our businesses are worth not zero.
Something.
They're not worth zero, but for now, take zero as the quote because that's what we got.
And just for those watching, those Zimbabwe plays actually ended up turning out threefold and eightfold returning to them. So
which is incredible.
Worked out, and there was some nuances and little things like they had to buy on the Johannesburg stock market and all of this. And I didn't really get into all that.
It gets somewhat sophisticated.
But it's very interesting because right away I was like, okay, he wasn't afraid of macroeconomics and he wasn't afraid to go outside of where he lived into kind of like what we would call safe markets.
Right. And you said they traveled extensively.
They did. But I'm going to continue on to the Zimbabwe part of it. Like, just for those watching, so my brother was actually in Zimbabwe during this period of hyperinflation.
Yes, that's right.
And he said, like, the people, so he was actually in Zambia, but he would travel into Zimbabwe.
Yes.
And he said the people in Zimbabwe would get paid, and if they got Zimbabwean dollars, they would spend them, like, as quick as they could.
Just to buy an asset.
Right, because he said you would go to a restaurant, and there'd be a hamburger for, like, $5 million. But then you'd go the next day, and the hamburger would be, like, $10 million.
Right.
Zimbabwean dollars.
Yes.
So a lot of them, they didn't even want to get paid in those dollars. They wanted Zambian dollars, whatever. But like just to give you an idea of like how bad hyperinflation was, he would talk to people and meet them, and if they got paid that day, in like as soon as they got their Zimbabwe dollars, they were gone because they knew they'd be worthless the next day.
Yeah. And so this is the places they're going to look for value. Is places where no one else wants to go.
Yeah. And they did well. Like I said,
and they did well.
Threefold and eightfold.
Yeah.
But they had to know it.
They had to know the business. And they knew it through and through. And I think you had mentioned something to the tune of they looked at and researched the company until looking at it further made them sick.
Yeah, I think they said, and again, like, so we were just able to take out so much information from reading their shareholder letters.
Yeah.
Not about companies, but just about money management and how they did it. And one of the things that stuck out was how they researched their company. So they didn't use analyst reports. No. They didn't listen to sales pitches. They said they read annual reports. Like you said, they would just have piles of them. And they traveled to all their companies until they were just sick of it. And they traveled a lot. And so they were really educated in any company that they were investing in.
So you need that confidence to have gone there and looked and whatnot. Now, they did describe some plays that didn't work out. I think you mentioned
about mistakes.
They do mention some mistakes, and I think there was at least one company that you referenced that you read about that went bankrupt. And
they were quite forward about their mistakes.
Yeah, and that's again what you want an asset manager is they're not going to be perfect. You can't. No one bats.
Well, and you're not going to be perfect.
No.
If he can't be perfect with all of his research and knowledge, there's no way that we'll have 100%
success rate.
So another thing that I was able to take away from their shareholder letters was their long-term thinking and just their need for long-term investments. I read somewhere that the average holding period, excluding Berkshire Hathaway, for their fund was 7 years, and at that same time, the average investor held for 51 days.
Which is crazy.
So 7 years and 51 days is quite a difference, and they had a really long-term outlook. And you read something which was like epiphanous to me yesterday. Yep. You were like, oh, listen to this. So why don't you...
So they had mentioned that what they try to do is look at the long term and predict what's going to happen over the next 5 to 10 years. Mm-hmm. And what he said is, I can better predict where a company is going to be in 5 to 10 years, likely market-wise, market cap-wise and whatnot, than I can in the next, 5 or 6 months. And that makes sense.
Yeah.
Right? If, in fact, the business is going to be developing as the management says they are and where they're going to allocate capital and whatnot, you can better predict, where the share price and where the market price is going to be at that point in time than you can in 6 months because the market fluctuates so much.
Yeah, and I was just like, and those time frames, like that does make sense. That wasn't so epiphanous, but for me, like what I took away from that was I'm always like, I don't want to think out further than 5 years because businesses change so much. But then it's like, wait a minute, if I really believe in the strength of this business, it actually is easier to predict 10 years, 15 years, because there are these short-term events, wars, interest rate hikes, interest rate drops. Like there's all these things that might take 2 or 3 years to play out. 5 years might not even be long enough. And I was like, you're right. And then he says, I think in the quote that you read me, he says that time is not actually risk, but people say time is risk.
Yes.
Because you're leaving it, right? Opportunity cost and all of that. And I was like, oh wow, that was super epiphanous. So I used to do 10 years out.
Yes.
And then somehow in my head, I was like, I don't know, like business has changed so much in technology. I was doing 5 years out, but I actually think now I'm going to go back to 10 years out. Yeah,
and that makes sense.
Yeah.
Well, think of a day-to-day quotation. If you open the price quote of Coca-Cola on any day, and this is Warren Buffett said, he's like, on any given day, you can open up the price quote for Coca-Cola and it'll be up or down or sideways. And you have no idea. Like it'll be, 50-50, will it be up or will it be down? You never know. But, in 5 years from now, there's a fairly reasonable probability or a higher probability than 50%, that it'll be worth more than it is today.
Right, exactly. Because
bottom line.
The vicissitudes of life, as Charlie Munger calls them, take time to just even out. One more point on their love for long-term thinking is that they hated quarterly reports. And they hated even more EPS junkies. I think they called them that, just EPS junkies. And, they talk about Wall Street. They just want short-term profits. And they talk about, there's a quote by Nick Sleep, I think it is, and he says, this is back when Costco wasn't a darling on Wall Street like it is now. And Wall Street did not like Costco. They didn't understand why they would take such thin margins. They didn't like that. And he's like, well, of course Wall Street didn't like that. Because what Costco was doing was they were pushing profits out into the future in order to get customers back.
Yes.
Right? And then he said, of course Wall Street doesn't like that because they want short-term profits now.
Yeah.
But as we know, Costco has turned into the behemoth it is, which I think we'll go on to the next point, which is what you wanted to talk about, economies of scale for the customer.
Yeah, so scale economies is something that I think changed their thinking in a sense. So they talk about really two companies that had scale economies. One was, the main one that they reference is Amazon, but Costco would probably fall under this umbrella as well. So scale economies for the customer is really where a business tries to pass on the best prices for the customer. So they don't use the whole typical, we're going to get you in the door with a sale, but, on this item, and we hope you buy this item, which is a much higher price, because that trains the customer to look for deals and hunt around and be disloyal. And so that's their main concern with those kind of businesses. But businesses that maybe take smaller margins, but sell everything at fairly reasonable prices, i.e. like Costco and Amazon, they said those companies get treated with customer loyalty. So customers keep coming back because they know they're getting the best price. So think of Costco. You go to Costco, everything there is much cheaper than elsewhere, so you keep coming back. Well, what does that do? Well, that then allows them to go back to their suppliers and say, okay, we're going to order more volume. And then they in turn pass that back onto the customer as even more savings. So it's a virtuous cycle that tends to happen. So they're rewarded with loyalty from their customers and low prices from their suppliers because they're not getting
allow
these.
them more low prices for their customers,
Exactly.
which is more loyalty.
Exactly. And if you contrast that to the typical business where they're doing the sales on the one item and high prices on another item, they're going to not get those rewards from the customers or the suppliers because the customers are going to, again, be disloyal, shop around, look for better deals. And the suppliers are going to get these blips. So they're going to order a bunch of this and then discount it and maybe not order that item again for a while. So it doesn't have the same virtuous cycle.
Yeah, that was very much like Rose Blumkin.
Yeah.
Right? What was her motto? Like, tell the truth.
Sell cheap, tell the truth, and don't cheat nobody.
No cheat. Yeah. Sell cheap, tell the truth, and don't cheat nobody.
Right.
And here's the thing: Nebraska Furniture Mart to this day is still one of those economies of scale for the customer.
Yes.
And that's how she ran it. She always passed on those savings to her customers.
That's right.
We do one on Rose Blumkin. I think there is, in fact, a story where she actually tried to sell it at no profit.
That's right.
And the cashier was like, well, we can't sell it for that because, we should be making some profit.
Right.
Yeah.
This carpet cost you X amount.
Exactly.
Yeah.
So she was kind of like the original. The original economies of scale for the customer thinking.
Yes. And I think at this point, Nick Sleep and Zach would also look at businesses where they were exactly doing that for their customer. They're trying to provide customer value and whatnot, and because in recognition that if you provide customer value, shareholder value will follow.
Right. So a big kind of like aha moment for them was when Amazon announced their Prime membership.
Yes.
And they were pretty much saying like, oh my goodness, this is Costco. This is the online Costco. And that, it was kind of like when they decided to like pile in to Amazon, and when they realized like they have, their prices are cheap, they treat their customers get what they want for the right price, and now they have this membership. And that was really a moment of clarity for them.
Yeah. And in one shareholder letter, they describe how Amazon, if they could even take a tenth of what some other businesses that were going out of business at the time, so Circuit City was one, Woolworth I think was another, and they said if Amazon can even capture 1/10 of the $150 billion market share that these businesses that are going out of business have, then that will increase their revenue or sales fourfold.
So they just had the foresight and the conviction to know, and they had studied Costco so much, and they also really love Costco, to see that like, wow, Amazon really is the online Costco. So there is a way in which they do analyze companies, and they call it destination analysis. And I kind of referenced this last week, but these are the questions that they ask. So this is from Nick Sleep himself. So I'll read the questions, and then we'll talk about destination analysis. So number 1, what is the intended destination for the business in 10 or 20 years? Number 2, what must management do today to raise the probability of arriving at that destination? Number 3, what could prevent this company from reaching such a favorable destination? Number 4, is the company strengthening its relationship with customers by providing superior products, lower prices, or efficient service? Number 5, is the CEO allocating capital in a rational way that will enhance the company's long-term value? And number 6, is the company underpaying its employees, mistreating their suppliers, violating customer trust, or engaging in short-sighted behavior that harms the eventual greatness? And even without breaking down those points, you can see what's important to them long-term.
Yeah.
Capital allocation, management that's honest and has integrity. So you can see all those things. But the idea of destination analysis caught my attention because you could use that like for everything.
Really everything.
Recently, I've kind of been just on socials really going after Nike and Disney.
Yes.
Because I really feel that their management is just dropping the ball.
Yeah.
There's these two like behemoth companies that people loved. Like both Disney and Nike held a special place in people's homes for so many years. And these companies have returned nothing to shareholders in, I think, like 5 years or more. And they've actually like alienated half of their customers, right? By pushing an agenda. And I'm not saying, I'm not like here to talk about like the agenda they're pushing or any of that. But what I am saying is like, when you have management that takes like a great company, doesn't return shareholders, alienates half their customers, something's not right with that management.
Yes, and so that's management you want to avoid.
Yeah.
Essentially, and those are companies that they would probably avoid too.
Right, and so if you were to use this destination analysis, let's use it on Disney.
Yeah.
What is this company doing that in 10 to 20 years it's going to be better? What are they doing that's going to harm their, whatever they're doing? Are they engaging in shady practices? Right? Like all of these things, and I'm looking at Disney and I'm thinking like, well, Robert Iger kind of is engaging in shady practices.
Well, one thing to look at now that I've kind of taken from this is to go and look in a sense at corporate governance and maybe share structure and whatnot. Because one of the things that Nick Sleep and Zach did when they structured the company, the business, they broke off from Marathon and started Nomad. They went and explicitly made it such that they couldn't sell Nomad. And so they put in a sense a Ulysses contract, which is what we had spoken on in our previous video, because they were going to avoid the temptation of potentially selling it. So if someone came along and offered them enough money, they may, who knows, capitulate and want to sell the asset management business. And so the lesson there is go through and look at corporate governance, because if the corporate governance is strong and whatnot, then there's a good chance that the management and whatnot will be held to that. And so I think from that standpoint, that's something I'm going to start looking for when I look at companies.
And I'm really going to start looking like, what are their choices? That question that Sleep says, like, what are they doing to make sure they can reach this grand destination?
Yeah.
And then the next one is, what are they doing that might derail them?
Yeah.
Right? And again, like back to Nike, one of the things that they did, and we caught this when they did it, was go to direct to consumer. And we said, and both of us were kind of like, wow, like they're pretty cocky in doing that, to think that they can get rid of the middleman.
Yes.
And sure enough, it really hurt them. And I have yet to hear the CEO come out, and he's kind of alluded to it, but a good CEO would come out and say, like,
we made a mistake.
That decision stopped on me. Yep. I was the CEO. That was a huge mistake, and we're going to do everything we can to get ourselves back on course.
Yep.
And the fact that he hasn't done that, and it's still COVID, and it's still China, and it's like all these things, but he hasn't come out and said that, to me, it's like, that's one of the things that might derail you from getting to that destination in 20 years.
Yes.
Because in that time, you had On Cloud take market share.
Yeah.
You had... Yeah, New Balance.
Yep.
Right? And if you look at people's feet, you're really seeing a decline on Nike. I'm not saying Nike can't come back. I'm not saying you shouldn't go long or short or whatever. But I'm just saying, like, you can see how asking those questions, what are they doing? What aren't they doing? And you can really break it down.
Well, one thing you said to me recently, which makes total sense, is they've lost their grassroots.
Yeah.
So they started as a running shoe company, right? And then they evolved, which makes sense. But now they've lost that edge in the running shoe business and, well, many other facets of their business as well.
So it comes back to like what we heard recently. I'm not sure, I can't remember who said it. Success breeds hubris.
Yeah, that was Howard Schultz.
Right, yeah, and that's kind of like, you can see that with these big companies.
Yeah.
And I think Jeff Bezos has said the worst position you can be in is number one.
Yes.
Because you have nothing like driving you to like pull you up. And that's like, when you get to that number one position, you have to be very careful, because success does indeed breed hubris. And the destination analysis is just a real good tool, really great questions to ask, especially when you're in a company that's number one. Are they still doing the right things?
Yes.
Are you seeing them kind of not trying as hard to stay on top, right? Are they making bad decisions? Because success breeds hubris, and you saw that with the direct to consumer, with Nike. You see that with Disney, and they think that they can just push whatever they want instead of... Robert Iger even came out and said, we need to stop pushing agendas and we need to tell good stories.
Yes.
But then they didn't
follow through on that.
They didn't follow through. So it's like, success really does breed
Which
hubris.
is interesting, because the question we always have is, how do you examine and how do you assess and how do you grade management? Mm-hmm. Well, I think you do it by just that. If they say something and do another, they get to fail.
That's a lie.
That's a lie.
Management is lying to you.
Yes.
Because they're saying what they know you need to hear, but they actually think you're too stupid to catch them not doing it.
Well, and that goes back to just the research you need to do. Read through their shareholder letters.
Listen to their earnings calls.
So if they said, we're going to be at destination XYZ, 3 years ago, and they're still not there, that's a problem.
Yeah.
And so you don't trust that company or that management anymore. Yeah. And maybe do that before you even invest in the company.
Yeah.
And one of the things that I've taken, not only from this research that we've done on Nick Sleep and Zach, I can't pronounce his last name, but on the Nomad Partnership letters, is the importance of management.
Yes, very important.
And I think we're also seeing it in the failings of some of these businesses that we're seeing now. And I use failings loosely, but you look at Nike, as you've mentioned, you look at Disney, as you've mentioned, and Starbucks. Howard Schultz was very critical of where Starbucks is going.
He wrote a long open letter.
He wrote an open letter to management saying, like, pointing out things and whatnot. And so these companies that were once beloved and titans in their industry are starting to crack a little bit.
Yeah, and one of the things so we talked about economies of scale for the customer, but they don't look only that they're treating the customer well, they also look that they're treating their suppliers well.
Yeah.
And they're treating their shareholders well. Like, it's a big group of people that need to be treated well in these companies, and Costco has done that, as we have said, in a few other companies. But one thing that should have been a red flag, and if you had caught it for Nike, and let's say you were long, you could have gone down if you had caught this, how they were treating their retailers.
Yes.
They treated them really horribly. Now, most of the news would have been on big retailers like Dick's Sporting Goods or Foot Locker. So no one really took that into account, because we all knew that, like, those stores still had other brands and whatnot. But There was one particular story that I read when all of this was happening, and we were like, why on earth are they going direct to consumer? And we were like so confused by this, especially shoes.
Yes.
When their bread and butter is shoes, like shirts and pants, but a lot of people like to try on their shoes, particularly if you're working out in them.
Yeah.
Right? But there is one story where there was a guy who had a shoe store in the States, and he took a gamble on Nike way back at the beginning of Nike, where no one really was
Phil Knight.
With Phil Knight. Yeah. Nobody was really buying Nike, but he said, you know what? I'm going to give you a chance.
Yeah.
And he was one of the first people to put Nikes in his store and give them shelf space.
Yeah.
And he was loyal to them. And eventually Nike became like 80% of his, obviously, because Nike became Nike. We all know the story. And it became a huge part of his revenue. And without any warning, he got a letter one day from Nike, not under Phil Knight, and said, we're pulling our shoes because we're going, and he had to close his shop. That ruined his entire store.
Yeah.
And that is just one of those things, and Nick Sleep says, do they have to do shady things to stay on top?
Yes.
That was a shady thing.
Yeah. Well, and as they're going direct to consumer and whatnot, you could see them eschewing the people who were loyal to them in the past, the retailers, like you said. So they were doing these shady business practices. And that
just to squeeze their top line.
To squeeze out the top line.
To make the shareholders happy. Whenever a company is only shareholder oriented, that's usually not great.
Yeah.
It needs to be everyone oriented. And the funny thing is, they were shareholder oriented, and in the end, they screwed shareholders over.
Yeah. Well, really, Costco's mantra from what I've observed has been, you treat your customers well, you treat your staff well, and then the shareholder results will follow.
Yeah, you sell cheap, you tell the truth, and you don't cheat nobody.
Exactly.
It's not that difficult.
It's not that deep.
But people, Wall Street in particular, want short-term gain, top line, EPS junkies.
Yeah.
But we have seen time and time again that these virtuous companies who are willing to push profits out into the future, who are willing to make sure their customers are treated right, are generally the ones that actually do end up returning the most to the shareholder.
Well, another observation that I made in reading these letters actually is that they often found themselves, and I don't know if this was intentional or not, but they often found themselves investing in companies that were founder-led and run. Yes. Many times. And so I think from that standpoint, the founders in these companies, they recognized that kind of secret sauce. And so they would treat their customers well, and they recognized that passing that savings on to customers or value added on to customers just produced a good company.
Right. And one thing I've seen, so they talk a lot about like prices. They also talk about other things like low prices being one for sure, but efficient source and superior products.
Yes.
And so it doesn't only have to be a low price.
No, it doesn't have to only be a low price. Honestly, you could take those 6 points and put them on a placard.
Yeah, you could.
And really examine those before you make any investment in any business.
So I was thinking of companies like Apple, right? What do they offer? They offer pretty good customer service. We've had really great customer service from them. Now, some people I've seen their arguments like they should just offer Apple Music for free. And you know what? That actually might not be a bad offer. That would be one of those things that would keep
people on the iPhone.
Because we've heard a lot of our kids and our kids' friends who at one point would rather die than not have an Apple.
Yes.
A few of them are changing over to Android.
Right.
Because of the prices. And I am willing to bet that if Apple just really did love their customers, economy of scale for the customer, and said, you know what? Every Apple user gets free Apple Music, just that one thing.
Yes.
They'd be like, oh, maybe I'm not going to change.
Right.
Just one little thing.
Yeah.
And like, would it cost them? Of course.
It would cost
them.
them.
But it would keep them, all of a sudden now, people are renewing their Apple phones. They're not going to Android.
Yes.
Right? You're still buying apps in Apple's App Store. You're still using Apple Pay. It keeps them in the ecosystem.
Yeah. And so I think that's what they're looking for is those kind of value-added propositions to keep customers loyal.
Yeah.
So this has been a bit of a lengthy discussion, which I think has been fruitful, at least for us anyways.
Which is why we do it.
Which is why we do it.
Even if no one watches, it forces us to really learn.
But we had mentioned that Nomad Partnership, the partnership did come to an end, and really Nick Sleep and Zach kind of rode off into the sunset and invested their own money.
Would we call it a glorious exit?
They had a glorious exit. So they had returned pretty much 10x to their partners over their run from 2001 to around 2014 when they closed their doors, which was stupendous. Like, you can't, if you find a manager that can do that for you, you stick with them.
Yeah.
And I'm sure a lot of the people who were invested with them were sad to see them close their doors. But I think there's a few things that did that. I think in the end they had mentioned that regulatory
Hurdles
became a major issue that they didn't really want to
in their last
contend with.
shareholder letter. He talks a lot about regulation, and he doesn't say when he closes the fund that it was regulation, but you could get the sense that they were getting frustrated.
If you read between the lines.
Yeah, so keep going, yeah.
So if you read between the lines, I think regulation was getting to be a burden and was going to be increasingly burdensome and maybe impact the way they invested. I'm not sure. And then they said that they had the opportunity to retire while they were young.
Right. This was when they closed shop when they were our age, mid-40s.
Yeah, in their mid-40s. So they said, well, we're in our mid-40s. We don't necessarily need the money anymore.
We have more money than we ever will need.
Right, and they had other pursuits that they wanted to pursue, and so it just seemed like a good time to close shop. And I think they really did love what they did. And
they must have, because they do.
They mentioned that several times in their shareholders. They said, we love what we do, maybe a little too much. And so I think from that standpoint, you wonder how much the regulation was going to be a burden and a hurdle. But either way, they thought it was time, and they closed their doors. Now it sounds like they manage their own money and do their own private pursuits, and actually remain quite quiet and private in their personal lives.
I read a little bit. I found a little bit on Nick Sleep in particular now, and what happened after Nomad, and he just loves the market. And I think people who will always love the market. I've never heard anyone say, there's a lot of people who have quit managing money, but they never leave the market.
That's right.
Right? They manage their own money. So I think that they return something, both Zach and Sleep return something like three times their money after they close, like their own personal money. So they're doing quite well, even after they close their fund. But there's one story about him with Amazon.
Yes, please go through
and
this.
And I
this
love
really
this story because I totally feel when I was reading it, I totally felt these emotions in my own soul. And he said that at some point, his Amazon position got outrageously big. It was just very heavily weighted in his portfolio. And he loved Amazon. And
for good reason.
Right, but he just said it was so heavily weighted, it was getting to him. Like, it was causing him a little bit of, stress. And so he had to cut his position down. And I can't remember what percentage he ended up selling, but it was a large percentage, and he sold it all at once. It was like, boom, one day.
Rip a Band-Aid off.
And he said it was so painful. He said even to this day, he doesn't know if it was the right idea. And he just said, it was so hard for him to do that. And I appreciated his openness, as Nick Sleep is. And he's a little bit of a romantic and a mystic. I get that from him. But I appreciated his openness in that, because when you love a company and it's hard and it's a good company, you love the management, but it's I can't put my head down on the pillow knowing that my wealth and my family's wealth, because he has a family, is 70% in one company.
Well, especially in a company where you don't have owning control.
Yeah.
So that I could see how he would not sleep at night. But then you're stuck with the whole investor problem of, where do I put this money?
Where do I
right?
put it?
So and especially when you have a company like Amazon, which has done so well for you. We felt that with some of our positions that have outgrown others because they're outstanding businesses.
Right.
And then you're, again, stuck with the problem of, where do I put this money now? In a business that is of this caliber, that's run by this management, that has such a wide moat.
That did so well for me.
It
treated me so well. And one thing we actually didn't mention, which I'm surprised about, because this was a running theme through all of his letters, was the psychological aspect of the investor, and how the psychological aspect is the biggest problem or your biggest strength as an investor in the market. And I think when he talked about Amazon, it was nice for me to end with that, because I was he really knew that the psychological fortitude of the investor was important. And so he obviously would have worked at that in his own life, and yet even he still, that endowment effect, when he said, I still don't even know if it was the right thing, he was obviously really struggling with that endowment effect. This is my baby, this was my investment that I watched and nurtured it and it grew.
It was nice to hear him talk about the psychological aspect of investing, because we came to this conclusion as well, maybe several weeks ago, in studying cognitive biases and whatnot.
6 months ago, because we've been studying it.
Yeah, we've been studying it for a while. Yeah. And so we came to the conclusion that oftentimes the edge in investing is not necessarily informational or speed or whatnot, but is actually psychological. And he breaks down the psychological aspects of investing many times in his shareholder letters, and he says that psychology often probably plays a larger part in the investing returns than a lot of other things. And so it was interesting to hear him come to that conclusion as well. So it was reassuring for us.
Yes.
And we did some videos, a little bit of a shameless plug for us. We did
Yes.
some videos on cognitive biases and recognizing that over the past few. So if you didn't catch those, go back.
Mm-hmm. So I think we'll wrap up there because we've kind of talked for a long time.
We have.
If you have made it all the way to the end of this video, thank you for watching. If you can like and subscribe, that really helps our channel.